Welcome everybody to our webinar about calibration in portfolio company valuations, VC and private equity portfolio company valuations. Really appreciate you taking the time to go through this. By way of background, I am Matt from Scalar, and I'm going to go ahead and share my presentation here. I think we probably have a host of different people of slightly different backgrounds, so hopefully this won't be too rudimentary or advanced for anybody. But if it is, my apologies in advance, I guess. There's an option that you have to ask questions along the way. We'll leave the end for Q&A, so if any questions come up, happy to talk through those. I don't think I'm going to be speaking for much more than 20 to 30 minutes. But yeah, we're going to talk calibration. Um, a little background on me and Scalar. So Scalar is a full service valuation firm. All we do is valuations for all kinds of reasons, but most of our clients are institutionally backed companies or the funds themselves. So we do a lot of foreign and A valuations, portfolio valuations, purchase price allocations, et cetera. We've been around for 15 years, done over 26,000 valuations, valued over 10,000 companies, work with 40 plus venture and private equity firms, from small seed stage firms to some of the largest venture VC firms in the country. So we feel like we've seen the full range of approaches and issues, and have enough experience, I guess, to impart a little bit of wisdom, hopefully. And that's me 5 years ago, when I had more hair and more chins, I guess. Um, First, we're going to start with a poll to kind of gauge your experience as it relates to calibration. So go ahead and answer that question. Give me a sense for who I'm speaking with. Doesn't let me vote, or I would vote. Excellent. So actually a fair amount of experience here. Great. Well, some of this may be a little too rudimentary then. Fair amount of experience with calibration. We're going to go through an example, a single calibration example as it relates to portfolio company valuation. Like I say, hopefully there's something to be learned from it. To set the stage, valuation approaches, there's essentially three buckets: market, income, and asset approach. So in the market approach, you have your public comps, your M&A comps, your projected exit, your back solve approaches. Within the income, you have a DCF, capitalizing earnings, asset, some balance sheet approaches. Basically, every way to value a business falls within one of these three buckets. You'll notice that missing from this is calibration, because calibration is not a valuation approach. It is a tool to help these valuation approaches, to make them more consistent, more auditable, more defensible. So what valuation challenge does calibration solve? It really solves the unobservable level 3 inputs challenge. So calibration is the process of aligning key inputs in valuation models with real world transaction data. We've probably all heard that valuation is a combination of art and science. Calibration helps make the art a little more scientific. In these portfolio company valuations, anybody reviewing them, in this case auditors, they're looking for consistency, defensibility, and market evidence for critical valuation inputs. And some of those valuation inputs on the market approaches are unobservable are your comp set. Why did you select these 8 or 9 or 10 companies as applicable comp sets? Your valuation multiple, why are you applying the 25th or the 75th or the 10th or the 90th percentile? Any adjustments you're making to that multiple. And the income approach, why are you using a 23% weighted average cost of capital? If the answer to that question is 23 is my favorite number, that's a lot less defensible than, well, 23% is actually the discount rate at which, or the discount rate implied by the transaction 10 months ago, Or in other words, if we discount the projected future cash flows that existed at the time of that transaction by 23%, it equals the purchase price so we calibrated that 23%. It's not just our favorite number. So that is what calibration is doing. It is assisting to make the art portion, the assumption portion of valuation a little more scientific. The PEVC guide defines calibration as the process of using observed transaction in the portfolio company's own instruments, especially the transaction in which the fund entered a position, to ensure that the valuation techniques that will be employed to value the portfolio company investments on subsequent measurement dates begin with assumptions that are consistent with the original observed transaction, as well as any more recent observed transactions in the instruments issued by the portfolio company. We all know how awesome it is to do a valuation or to audit a valuation when an arm's length transaction just occurred, yesterday. It's like, oh, great, we can rely on that. There's just an observed market transaction. So there's a lot of confidence, a lot of auditability. It's taking that confidence and auditability and carrying it forward to subsequent, slightly less observable valuation approaches. Calibration, if you read through the guidance, it's probably more than just a suggestion. Some of the guidance says the valuation technique shall be calibrated, or calibration ensures that the valuation technique reflects current market conditions, or a reporting entity shall ensure that those valuation techniques reflect observable market data. So it is highly encouraged, if not required, when you kind of start reading through and looking at the guidance. Let's do one more poll to see how much or how frequently it's been discussed in the past and the experience of the audience. All right. So in some cases it wasn't discussed, at least directly, and others partially. And as assumed, I wouldn't think that every last valuation was expected to do a full-on calibration approach. The process, generally, you could consider it in two buckets: day one, or day of transaction, and then how that rolls forward to our current measurement date. So the day one steps: first, you have to confirm a transaction is arm's length. Just like if you're relying on a transaction, if you're relying on the calibration approaches from a transaction, was it a relevant transaction? Was it arm's length? Was it negotiated, not distressed? Assuming it is relevant, then what are some key inputs that are implied from that transaction? So what was the entry multiple? In private equity, you often hear, what was the entry EBITDA multiple? Well, we entered the investment at 7 times last 12 months EBITDA. Or what was the entry revenue multiple? What's the implied IRR? If there's no projections, sometimes you can actually calibrate projections if needed. So a lot of key inputs that could be used later on that can be implied or inferred from that transaction. And then it's also worthwhile, kind of highlighting in step 3, to see how the company's performance, how the company is performing on that day, and be able to compare it with your next roll forward measurement period, and how its performance compares with any peer group that may be used in subsequent measurement approaches. And then, so that's kind of first bucket. Next bucket is then using those inputs on subsequent measurement dates with other valuation approaches that don't have a recent transaction to rely on. So let's let the rubber meet the road and actually go through what I would call a relatively simple example of calibration, but hopefully it can spur some create some questions and discussion. So here is a company, and I guess by way of background, Scalar has softwaretized our portfolio company valuation model. In 15 years of doing it, we just found that this, more than any other valuation we do, is very collaborative in nature. You have multiple stakeholders, and the firm wants to have access to this valuation later on, or might take themselves, or the firm might internally value 10 portfolio companies and Scalar only values 4 or 5. So because of a whole host of reasons, we softwaretize our portfolio company valuation model. So that's what I'm going to be using to go through this example, rather than Excel, but similar concept. In this case, we have, I'm going to start with a 6/30/2023 measurement date. So we are in the middle of 2023, if we can time travel, valuing SaaSyco. SaaSyco is an enterprise software as a service company. They sell subscription software to kind of get a sense for their performance. If we go to their financials, you'll see, they're pretty healthy company. Obviously not huge. It's a private company, venture backed. Did $5 million in revenue in 2020. There was a little bit of plateau in 2021. They might have been the only software company in the world that plateaued in 2021, but 5 million to 5.2, and then started to reaccelerate growth. So single digit growth, 43% in 2022. So the most recent fiscal year, and they're kind of projecting to continue that growth. Not bleeding a lot of cash. I think they have $10 million of cash currently, similar debt balance. So pretty healthy company, and attractive, as evidenced by the fact that they just raised a round. So if we look at their cap table, they have some options in common. They raised a round, Series A, their first round in the middle of 2020. Now fast forward a year, raised an up round, so from $1 to $1.80, a Series B at pretty plain vanilla terms as well. So if we look at the terms, 1x liquidation preference, non-participating, et cetera. So we're valuing it as of 6/30, and we have a transaction that occurred basically a month ago. So this is a valuation, evaluators, appraiser, and auditor's dream. We have this market transaction, let's say it's outside led, heavily negotiated. So we got to do a valuation. Pretty easy. We are probably going to rely on that round. So I'm gonna create a back solve. The one thing we know, and there's a lot of ways to do a back solve. You can do an OPM back solve. You can do a CSE back solve, which is essentially the post money. For this purpose, I guess I'll show you both. But for this purpose, we're gonna not go into the nuance of that and just keep it simple at a CSE back solve. And so I'm going to choose CSE allocation. We know that Series B, because this is an observed market transaction, we know that Series B equals $1.80 because an outside party just paid, sorry, $1.80 per share because an outside party just paid that. So I want to solve, and the software is automatically doing it for us, but I want to solve such that one Series B share equals $1.80, which happens to equal an equity value of 108 million or an enterprise value of 110 million. That equity value is essentially the post money. There would be some small adjustment for the non-granted option pool and the strike price of the options, but it would be very close to the post money. Not coincidentally, all the shares equal $1.80 because it's common stock equivalent, except for these options who have a 50-cent strike price, so they're worth a little bit less. If we did want to do an OPM back solve, just to take a brief deviation, requires some additional inputs, which we would probably pull from public comps. But if we did say, well, we kind of want to take into account the different rights and preferences and things, we would still be solving such that one Series B equaled $1.80, but the junior preferred and junior common are equal to less, and so the implied valuation is no longer 108, it's 73, and you can't actually, this is down just me being a valuation nerd and showing off something, but you can do a hybrid back solve, or it's if I weighted an OPM CSE 50/50, what is the single equity value that will cause those two weighted conclusions to equal that $1.80? And the answer is 92 million. So what we're trying to get to is the implied valuation from this. We're going to keep it simple and just do a single allocation CSE. So if none of that made any sense, basically we have a transaction that we're relying on the post money to infer a value on the company, and more importantly, to infer a value on the firm's investment position. I'm going to add an allocation scenario. We're going to make sure we're apples to apples. So CSE, we're going to weight that transaction 100%. So our $110 million enterprise value results in $1.80 per share, not coincidentally, because we're basically saying, hey, there was just a $1.80 transaction. So we're marking our Series A also up to $1.80, which means our Fund 1 Series B shares naturally equal cost. I'm going to display this in full dollars. They were purchased for $9 million. They're still worth $9 million. It's only been a month. The Series A, though, was purchased for $2.5 million, and it's now worth $1.80 based on the Series B transaction. So it's up to $4.5 million. So there's some appreciation on the Series A. That, pretty Pretty easy valuation. Took me, what, 4 minutes, but it really took us 4 seconds to get to the conclusion, which is all shares are worth $1.80 because we have this arm's length transaction. Um, Valuation's easy, but calibrating to that valuation kind of sets us up for success when the valuation is less easy. So I am going to add one more valuation approach, specifically a public comps, not because we're going to rely on it, but because we want to put it together and calibrate some of the assumptions for when we do rely on it in the future. So here's public comps approach. There are no companies in here, so I'm going to add some. I happen to have pre-selected 6 large enterprise SaaS companies. Most of the names you'll recognize: Salesforce, Intuit, Workday, Workiva, HubSpot, etc. So we're going to add those, and it's going to give us the last 12 months revenue and EBITDA and next 12 months revenue and EBITDA as of this measurement date. So they're kind of trading for 6 to 14 times on an LTM basis and 5 to 11 times on an NTM basis. We would use these multiples to value the company if we didn't have that recent transaction. And we still can use those multiples, but rather than trying to figure out, and I suspect, we at Scalar usually start with the median and then adjust from there, or think about, is that appropriate? Should it actually be the 25th or 75th or something else? But if we're at the median multiple, I'm going to manually calibrate this. There's a way of automatically doing it, which we'll get to. But if we're using the median multiple, 7.8 times, values the company at 96 million. But we just had a transaction that said the company is worth 110 million. So the median is not the appropriate calibrated multiple. Maybe it's the 75th percentile. 8.3, we're still not quite there, 102 million. So it's actually something above the 75th percentile. Let's say, hey, what about the 90th percentile? So I'm going to go to the 90th percentile 10 times. Now we've overshot it. We're kind of honing in on what that multiple is, and I think it's probably right around 9. Let me see. Yeah, 9 times. So our valuation implied was a $110 million valuation at a time where we, or the portfolio company, was projecting 12.3. So the calibrated NTM revenue multiple is 9 times. That's essentially the entry NTM revenue multiple. What does that mean for the implied percentile for these public comps? So we just calibrated to the multiple, but now we can use that to calibrate to the percentile. And something tells me it's probably pretty close to, we know it's not this, it's higher than the 75th and it's lower than the 90th. I'm going to make an educated guess that it's the 83rd percentile. Very close. Not exactly, but it's probably the 83rd and a half percentile. So now if we go to our valuation summary, we're still only, did I not weight that? Sorry. Yep. Didn't actually weight that multiple. Now, if we go to our valuation summary, we're still only relying on this back solve because it is the most relevant indication of value, but we have another supporting and fully calibrated valuation approach that's ready to go when this back solve is dated. So we've calibrated to the 83rd percentile, or to a 9 times NTM revenue multiple. So I'm going to save this. Our valuation's done. I mean, it was done before, but we've set ourselves up for success in the future. And jump forward. If this measurement didn't exist, we could create it in the software. I already created it. Jump forward to 12/31/2024. So again, to maybe take a brief look at the financials and cap table, we would have rolled those forward and then updated them, which I've done before this webinar to not bore you guys with those details. But I think the company was projecting, last time we were in the middle of 2023, they were projecting 10.2 million in revenue or thereabouts. They did 9.7, so they fell short, but they still grew by 29%, pretty healthy. And then they re-accelerated growth to 36%, 13.3 million, and they're kind of projecting now to maintain that 34% growth to 17.8, 25.8. So qualitatively, company seems to have performed quite well and is continuing to perform quite well. We'll take a look at the cap table. Obviously, if there was another transaction, we'd probably now rely on that Series C or any other secondaries. Looks like company's still got plenty of cash, no other transaction. So when we go to do evaluation, we could rely on this back solve, but, and just for clarity, I'm going to name it a 6/30/2023 CSE back solve. So it is a it's an 18-month-old transaction, which is, usually transactions considered relevant for 6 to 12 months. 18 months is kind of pushing it, especially where this company is performing, has financial performance where you can confidently rely on other valuation approaches. Uh, so we probably shouldn't use that as the indication of value or maybe even an indication of value. Let's go to, thankfully, we set ourselves up for success and did a calibration. So let's use a public comps approach. I'm going to, had I rolled this over, these comps would actually already be there, but because I added the comps after the fact, I'm going to have to add them again. Same 6 companies. So we're saying consistent with the set. This data is pulled from Capital IQ. Same 6 companies, but slightly different multiples. So the 75th percentile is now north of 9 times because the market has changed. But starting from like a really simple calibration, we could say, well, our entry multiple was 9 times. So we are going to use 9 times. The company now has a higher, our entry NTM revenue. At the time, the company was projecting like 13 million in 12 million in NTM revenue. Now it's 17. So even if you apply the same multiple, naturally it's appreciated because it has grown, its performance has increased. So that's a really simple, we actually didn't even need our comps to do that. We could have just applied it 9 times to do it. But then we are using the observed market transaction to inform this assumption, but we're not accounting for, macro or market economic changes. So we probably should think about multiple selection here. And let me deviate again. I already did that calibration to kind of set this up. But had we not, if this 1231 valuation was the first valuation that Scalar or anybody else was doing in the software or elsewhere, you could still go back and calibrate. And we've kind of given ourselves a convenient tool where we can create a calibration where you kind of have calibrated inputs and then calibrated or assumption outputs. So we are going to calibrate, again, pretend like we didn't do it previously. We're going to say, well, we do know that we had a valuation right around the middle of 2023, a transaction right around the middle of 2023. It implied the company was worth 110 million. And let's select the financials that were in place at that time, the 630 financials. They 110 million at a time where the company had just done 8.9 million in revenue, was projecting to do 12.3 on a next 12 months basis. And if we rely on our public comps, that 110 million divided by 8.9, that implies a 12.35 times multiple. 110 million divided by what was projected in the next 12 months implies a 8.94. I've been using 9 times, but it's technically 8.94 times next 12 months revenue multiple. And how does it fit with what the comps were trading at as of this day? Well, we already did this, but that's why I was able to be informed. It is, and I forgot to explain this. I'm focusing on the next 12 months revenue multiple because that's often SaaS companies can kind of project their next 12 months revenue with a fairly high amount of confidence. So that's often the multiple they're value off of. So to keep things simple, I'm just focusing on one multiple, but it could be both. That calibrated next 12 months revenue multiple also results in a calibrated 83rd percentile, meaning it fell based on its performance, that value, it fell in the 83rd percentile of these 6 companies at the time. And some things to note, it's projected 38% revenue growth at the time, or historical 38% was above everybody. There's a 38.4, but it exceeded everybody. It's obviously its size is smaller than all these large public companies. So it's in the 0th percentile. It's very bottom. It's size wise. But for revenue multiple, especially next 12 months revenue multiple, we focus on growth and gross margin, probably more than anything else. So from a growth basis, it was higher than everybody. And gross margin, I think it was, lower than everybody. So right around the minimum, gross margin was 68%. So those were the factors in place at the time that the market said it fell in the 83rd percentile, this comp set. Fast forward to today, and I think its performance still compares pretty similar. It's still above everybody from a LTM and NTM revenue growth. And in fact, its NTM kind of looks better because nobody's doing, even in the 20s anymore. And I think its margin is still kind of underperforming gross margin. Well, it's right there, kind of hovering around the minimum. So I would say it falls in line. The same calibrated percentile is probably still relevant. If it was performing way worse relative to the comp sets now than it was, then we'd say, well, we were the 83rd percentile, but we should probably change to something different. That being said, um, and the other thing, some of our clients, rather than pegging to a percentile, they'll have like a premium above the median or above the mean. So that 8.94% represents a 9.2% premium, which sometimes can reduce volatility. So all of that helps to solidify assumptions in the public comps. We could say, like I say, we could be like entry multiple is 9 times, or maybe more appropriately in capturing market, the entry multiple was the 83rd percentile. Seems very precise, but the 83rd percentile of the public comps, which used to be 9 times, but now it's actually 10.76 times because the market has gone up. So if we select that 83rd percentile, weighted 100%, our $110 million company has now grown and is worth 192 million based on that. Or if we want to do the premium thing, let me allow us to add a premium to the selected multiple. We could say instead we're going to start with the median, but then apply our 9% premium that we calibrated to. And I actually think it was the mean that we calibrated to. So rather than 190 million, it's 173 million, a little less volatile, as I mentioned, but also probably defensible. And when it's being audited, if somebody, if auditors say, well, they're struggling with, well, why 9%? Seems like a bizarre number. There's support for it. Basically, an observed market transaction is now supporting subsequently an unobservable input. Go to the valuation summary. What this means, probably can't rely on that transaction anymore because it's 18 months old. So we're going to rely on, but that transaction is still supporting some of these assumptions to value the company 173 million allocated using a common stock equivalent means everything's worth 284 per share. The Series B is up 1.58 times. The Series A is up 2.84 times. So that is a calibration example in a nutshell. Again, taking the confidence of an observed market transaction, and even though that transaction itself can't be carried forward 18 months, because that's probably pushing it, the relative metrics calibrated to that transaction can be carried forward, and hopefully the confidence and accuracy and validity of your valuations in turn. Stop sharing my screen. I promised 20 to 30 minutes. True to form, I took my full time, but all right, we got some questions. What is the process of calibrating a DC? Oh, we'll start with the top one. How might we calibrate using the income approach? Those are both the same questions. So how might we calibrate using the income approach, or what is the process for calibrating a DCF approach? Uh, I, in full transparency, picked an easy example because there's not a lot of moving parts, or there's less moving parts. So we calibrated to a multiple, and I used a single multiple and then kind of peeled back a few layers. Calibrating with the income approach can be more difficult because you have more moving parts. Are you calibrating uh, the projections, or are you calibrating the discount rate, or are you calibrating the terminal value? But really you have to decide, and I would say the discount rate is probably the most commonly calibrated thing, holding the projections and terminal value calculation type constant. Listed in 630 are going to be different than projections. Sorry, 630 2023 are going to be different than projections that existed 1230, or they exist 12/31/2024. But at least now that 23% discount rate that you're using can be you can be more confident around it, or the cost of equity, you can peel it back down to like a calibrated cost of equity rather than a calibrated aggregate discount or weighted average cost of capital. Um, but yeah, and there's also adjustments to it. Just like we didn't adjust the multiple, but I kind of referenced how you could decide 83rd percentile is no longer relevant if our our projections were really aggressive. Their company was going to quintuple every year for the next 5 years, and we calibrated to a discount rate. And fast forward 18 months, and now they've got a new CFO and much more reasonable, and it's like single-digit growth. We probably shouldn't use that same discount rate, but at least that discount rate gives us a reference point from which we can adjust. Hopefully that. If I should display my contact information, if there's any subsequent follow-ups or I don't answer your question to your satisfaction, happy to have conversations kind of after the fact. Next question, can you only calibrate to primary fundings or can you also calibrate to a secondary transaction? You can absolutely calibrate to a secondary transaction. It's kind of the same process. Step one, is it a relevant indication of value? Is it the relevant indication of value or a relevant indication of value? Either way, what is the implied valuation, right? And then now you have that 110 million or 150 million implied by the primary or secondary transaction. What does that mean, or what does that imply for these other assumptions that I'm trying to calibrate to? So yeah, we maybe slightly less frequently, but we certainly do calibrate to secondary transactions, especially if it's large and repeated and things. If there hasn't been a transaction for 2 to 3+ years, do auditors still expect you to use calibration? Sometimes, depends on the stage of the company. If a company raised money and it was pre-revenue, there's like limited things you can calibrate to, right? Pre-revenue and had no projections, idea stage, and fast forward 2 to 3 years and it's still pre-revenue and idea stage. Sometimes we're just adjusting. I mean, in a way, a backsolve is a calibration, so there's some calibration there, but we're just adjusting that equity value in aggregate for market changes. Um, so yeah, I don't think it's less about the time that has passed and more about the stage of the company. Though the time that has passed, probably the longer the time that has passed, the more likely you are to adjust rather than using that 9x entry multiple or even the 83rd percentile. You're starting with those, but probably more likely to adjust rather than sticking with the 83rd percentile than if it happened a little more recently, because the world is probably a little less different. Do you scope calibration into all your projects or only if asked? Great question. Um, I would say where appropriate and where it's helpful to us and any reviewers. So, uh, we typically charge per valuation, um, whether that, you know, need calibration or not. If there is a recent transaction, but we're doing some sophisticated, hybrid back solve, I mean, again, technically a back solve is a calibration, but uh, we aren't doing some of the stuff that I talked about here just because it's not necessary. Um, and when we need it later on, we might do it to set ourselves up for success later on. But as I showed you, we also have a way to kind of retroactively calibrate when we do need it. But if we're using, we're relying on, we have a good solid transaction, but it was 20 months old, and now we're using public comps, and the company's kind of financial performance supports that. We'll definitely calibrate so that when auditors say, hey, why did you pick the 75th percentile? We have a couple of company specific answers, but then we have like the calibration answer, which generally behooves us because there's just less back and forth and, pleases the reviewers and everything in between. Great questions. Nothing else. All right. Well, trying to see if my presentation had my contact information. It has my email address on there. So if for some reason you have any follow-up questions, calibration or otherwise, valuation, Utah Jazz, that's about the areas that I'm an expert in, then you feel free to email me, reach out. Always happy to hop on a call. We're happy to be a resource. Like I say, we have dozens and dozens of clients, but probably double or more than that of quasi clients where we are kind of a sounding board or evaluation professional where we can talk through stuff. We might do one-off projects for those firms or funds. They still try to do a lot of it internally, but if they want to get an outside perspective, we're always happy to be a resource. So really appreciate everyone here taking the time